Now looking at the second table, the assumptions change. Instead of a well-behaved market with normally distributed returns, this version adjusts for the current conditions we just walked through: elevated valuations, yield curve dynamics, macro slowdown risk. In essence, the model is effectively reflecting the fat tails and regime shifts that standard implied volatility models tend to understate. Once you do that, every number moves higher, and not by a little. Every cell in the adjusted table is larger than its counterpart in the standard model. Accounting for today's risk environment pushes downside probabilities higher across the board. But the more important shift isn't just the level of risk. It's how the shape of the distribution changes. In the standard table, the market looks fairly well behaved. Big corrections are possible, but deep crashes look like long shots. In the adjusted table, everything shifts up. A 10% pullback rises to 90%, and the 30% crash jumps to 18%. The point is not that a crash becomes the base case, but that the left tail gets heavier once you layer in today's valuation and macro backdrop. So the takeaway is simple. The market can keep grinding higher, but the downside is no longer priced like a clean, low-vol regime. The same rally can coexist with meaningfully higher odds of a deeper air pocket. For a detailed breakdown, watch the full video on my channel.